Thank you for joining me. I'm Alex and I want to talk about Nike today. So Nike, obviously a company that has gotten a lot of free press over the past couple of weeks, and that has boosted their brand somewhat, and I would expect them to do quite well, not just because of that, but also because obviously the fitness industry is getting bigger and bigger, and obviously they're one of the major brands in the whole industry. So what they do is mostly shoes, apparel, some sports gear and other stuff. Current price is $104, which gives them a market cap of $162 billion, so definitely not a small company. Current dividend yield just under 1% with a 34% payout ratio, which isn't terrible, but obviously if you're looking for big dividends, this is kind of not what you want to go for. Revenue $39 billion, up almost 10%. Earnings $4 billion, up over 100%, and that gives them a PE of 39 with a forward PE also 39. Forward PE actually higher than the current PE, but not by much. Total assets $24 billion, total liabilities $15 billion, which gives them a total stockholders' equity of $9 billion, which is actually going down. Not a great thing, certainly, but I think that their balance sheet will be able to handle the current situation, and they will obviously come out the other side probably even stronger than they were, and I have no doubt that they can survive this whole thing. A recession would probably affect them quite significantly, because there's obviously Nike is obviously a name brand, and people can buy cheaper brands, cheaper stuff, no name stuff, and I think that the brand recognition will help them longer term, but if there's a huge recession coming, then they will also dip quite a bit. So obviously, for a growth investor, I don't think the growth here is really good enough for a growth investor. 10% certainly not nothing, but obviously when you're starting with a market cap of $162 billion, there's not too much room to grow. There's only so much market share they can get. So not a great stock for a growth investor. For a dividend investor, I think that the dividend is quite low, but the business is obviously very safe. So if you wanted to diversify into something, then this might be a candidate for that, but I think the dividend is quite a bit too low to consider it as like a reasonably big investment in a dividend portfolio. For a value investor, I think the PE is way too high. The balance sheet isn't looking terrible. It's almost great, but it's definitely good. The dividend is a nice bonus, and so overall, if you're willing to look past a PE of 39, which in the current situation where bonds pay almost nothing or literally nothing, then it certainly is not a terrible investment. But I think that there's better companies out there with a better long-term growth, better dividend, even better balance sheet, and even at the same time. So overall, I would say that if you're wanting to diversify, this might be a good stock. It's a very safe stock, so I wouldn't blame anyone for investing in this, but I think there's definitely better opportunities out there right now. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.